All right, Scott, can you hear me?
I can.
Okay. All right. Thank you, everybody, for tuning in to our latest webinar. Pleased to be joined by my colleague, Scott Barnes. And today we're going to be discussing estate and inheritance taxes. What are estate and inheritance taxes? Who needs to worry about them? And how can we prepare for them or even minimize them? That's what we're going to be talking about today. Before we dive into this topic, a friendly reminder to subscribe to our YouTube channel. If you go to YouTube and search Hapanowicz Financial, you will find our page. The recording of this webinar will be posted there, and we are pretty regularly updating our page with new content, timeless content, and time-sensitive content as well, based on what's going on in the markets and in the economy. So make sure to check out our YouTube channel, a lot of good stuff there. And now I want to turn it over to Scott. Scott, why don't you give us a little more of an idea of exactly what we're going to cover today?
Yeah, sure. So thank you again for everybody that's joining today. Really appreciate that you took the time to view the webinar. Today we'll be talking about, again, estate and inheritance taxes and who they may impact. We'll look at the differences between the federal estate tax and the estate taxes that some individual states impose and state inheritance taxes. We'll discuss some strategies that can be utilized to minimize potential taxes and some common mistakes to avoid when planning for your estate.
All right, wonderful. So let's move on to that first topic. You know, estate, estate tax, federal estate tax, inheritance tax. It's all sometimes a jumble of words when you're trying to talk about it together. But let's compare and contrast what the two are and just provide that definition to everyone to lay the foundation.
Yeah, sure. So the best way to look at it is there's two types of estate taxes. There's a federal estate tax, and then there are state-imposed estate taxes. An estate tax is a tax on a decedent's right to transfer property at their death. It consists of an accounting of everything you own or have a certain interest in at the date of death. The types of property included may consist of cash, securities, real estate, insurance, trusts, annuities, business interests, and other assets. And the tax itself is based on the overall value of the estate. The tax is paid by the estate of the decedent before assets are distributed to heirs. So there is a federal estate tax again, and some states impose their own estate tax. The federal estate tax is a progressive tax, and I'll sort of describe what that means on one of the next slides. And it applies to estates with values over certain exemption limits, which we'll review. And there are
Mhm.
also 12 states and the District of Columbia that impose their own estate tax, and each one has their own exemption limit and tax rate. And again, we'll review that on a later slide. As of
Okay.
2025, there are 5 states that impose an inheritance tax. And an inheritance tax is a tax on a beneficiary's right to receive property from a deceased person. Unlike the estate tax, that's paid by the estate before assets are distributed to heirs, and inheritance tax is paid by the individual when they receive the inheritance. And currently,
Mhm.
all states that impose an inheritance tax have much smaller exemption limits as compared to state or federal estate taxes, thus making it more likely that a tax will need to be paid.
Okay. All right. So, yes, let's talk a little more about the estate tax. And I know you're going to, I think, explain a little more the federal estate tax versus
Yeah,
those specific states who also apply a state estate tax. Is that correct?
that's correct. Yeah, we'll
Okay.
start off with the national or federal estate tax and how that works in particular. Then we'll move on to the state estate tax and then state inheritance tax. But
Okay.
for 2025, the federal estate tax exemption is 13.99 million for individuals and 27.98 million for couples. And like income taxes, the estate tax is progressive. It ranges anywhere from 18% up to 40% of the amount over the exemption limit. So it really just depends on where you fall within those limits, whether you'll be taxed at an 18% or 40%. But the big thing I want
Mhm.
to point out here is that 13.99 million for individuals and 27.98 million for couples. It's very unlikely that the majority of folks that we work with and the majority of folks that are likely on this call will have a federal estate tax issue.
Mhm.
These current limits that we're currently seeing right now were put in place via the Tax Cuts and Jobs Act of 2017. That act effectively doubled the exemption amount of 2010 and has adjusted them for inflation each year since. The act is set to sunset at the end of this year. And if Congress does not pass new legislation, the exemption amount will be cut in half to around 7 million for individuals and 14 million for couples.
Mhm.
Approximately 2 weeks ago, the House was able to pass a budget resolution, which includes a 10-year extension of the Tax Cuts and Jobs Act. This was the first hurdle to getting the bill passed, and we'll be monitoring the progress closely over the next couple of months. Again, that's the first hurdle. There's a lot of work that needs to be done in order for this to actually go through. So we'll be watching it and obviously keep everyone updated as to how that progresses. And if something does change or doesn't change by the end of the year and the tax cuts or it does sunset at the end of the year, we'll be sure to notify people as we get closer to that time.
Mhm.
The chart on the screen here just shows the changes that have occurred each year since the TCJA was passed. So as previously mentioned, if the bill's not passed by the end of the year, it will sunset. So again, it sunsets back to that 7 million or so for an individual or 14 million for a couple in 2026 if it's not extended beyond 2025.
Mhm. Yeah, just to reiterate, something you said a minute ago, for those watching and not just listening right now, what you can see is the third bullet point on this slide. And currently, due to the exemption limits or levels, that a federal estate tax applies to less than 1% of Americans. And even if that exemption were to come back down to that 7 million estimated number, I believe that's still a pretty small percentage of Americans that would be affected. Isn't that correct, Scott?
Yeah, that's correct. I think it would pull in maybe 2% instead of 1%. So
Right,
it's a
right.
very, very small amount of folks that will actually end up being subject to the federal estate tax.
Yeah. Now, I guess there is a very specific group of individuals or families who, under current laws, may not have to worry, for lack of a better word, about federal estate tax. Um, And then depending on where their net worth value is at that time, they may have to consider federal estate tax if the exemption does come back down to 7 million. And so again, just to reiterate something you said, that this is what we're going to be watching for, clients who do work with us. If you do fall within that range where you could be affected, if the exemption levels do not remain the same, then we will be reaching out to you. We'll be reaching out to your attorney, and we will all be working together to come up with a game plan. But yeah, it's interesting that I think federal estate taxes are a commonly known topic, but it actually applies to very little amount of people, but
Yeah,
still important to know about and have an awareness about.
yeah, it certainly is. And again, there's a lot of I would say media noise around the estate tax, the federal estate tax. But again, it applies to so few people that it is wise to know what's going on. But in general, you're not going to necessarily be impacted by it. And that's
Sure.
where looking at the state options or what happens in the states becomes a little bit more important because those will end up capturing more folks.
Mhm.
And so let's take a look at the state uh, and just sort of how they work. Again, there's two types. So the this is what so let's take a look here. Oh, okay. I'm sorry. Before we get to the state, we need to take a look at a federal estate tax example. And I apologize. I was hopping ahead of myself already.
That's okay.
Um, so we did want to give an example of how this works as a federal estate tax, just to show what it would look like if somebody were to be subject to the federal estate tax. So in this example, we have Mr. Smith. He has an estimated estate valued at 17 million. And again, that 2025 estate tax exemption for an individual is 13.99 million. That means that Mr. Smith's estate will owe taxes on $3,010,000. So again, it's not the full 17 million that he owns. It's just the amount above that 13.99, which is $3,010,000. And as I mentioned before, it is a progressive tax. So on the first 999,000 over the exemption limit, the tax ranges from 18 to 39%, and anything over $1 million is taxed at 40%. So on that first million over the exemption, he would pay $345,800. And on the next 2,000,000, 10,000 over the limit, he would pay 40% or $804,000. So the total
Mhm.
federal estate tax due would be $1,149,800. So again, that's in 2025. So that's what the rule looks like today. If it does sunset at the end of the year and goes into 2026, you can see that it will end up capturing quite a bit more. So the estate tax exemption will drop to approximately $7 million. And that would leave Mr. Smith with an estate owing, or his estate owing estate taxes on $10 million. And on that first million, again, he'd owe 345,800, and on the next 9 million, he would owe 40%, for a total of 3.6 million, for a total estate tax of 3.945, or $3,945,800. And again, while this estate tax impacts very few families, if it is allowed to sunset, again, it could end up capturing in more of the folks that we work with, or even if we don't work with you, if you have an estate valued in between that 7 and like 14, 15 million, you could end up being captured by the sunset of the TCJA. It's really important. I mean, you can see the difference that it makes. We go from owing, I mean, not that 1,149,000 is not a large amount. It is, but we increase that by about 2.8 million I mean, if it does sunset. So
Mhm.
it changes quite a bit, and it can be quite onerous if it does sunset back down to the lower levels.
Mhm. Sure.
So now we'll jump in
Okay.
to looking at each of the states, and I'll give you sort of an overview again of what we're looking at today. Each of the 12 states in the District of Columbia that levy an estate tax have their own exemption limits and tax rates. This also applies to the 5 states that have an inheritance tax. The lucky folks are the citizens of Maryland, where they're levied both an estate tax and an inheritance tax. And as previously discussed, an estate tax is levied on the estate before the assets are distributed to heirs. An inheritance tax is levied on the person receiving the assets that are left to them. So there is that difference. So let's take a look real quick at the state estate taxes. And for those states, you can see there's a wide range of estate tax exemptions that each of these states have, from $1 million being exempt from estate tax in Oregon to up to 13.6 million being exempt from estate taxes in Connecticut. Hawaii and Washington have the highest potential tax rate of 20%. The rates and exemptions shown are as of 2024, and they do and can change each year. So if you live in one of these states, you'll want to periodically check with your estate planning attorney and advisor to see if there have been any changes.
Okay, so just to confirm, what we're looking at here is the tax that has to be paid from the estate before it is distributed to beneficiaries at the state level.
That's correct. So let's say, for example, you're in Oregon again and you have a $3 million estate. Anything over that $1 million will be subject to the estate tax. And again, it varies in range as to, it starts out lower, then goes higher. But again, that $2 million over that million will end up being subject to the state estate tax.
Now, if in Oregon, let's use Oregon again, if
Yeah.
the total net worth or the total value of the estate is, let's say, 30 million, then that means they're going, that estate will have to pay federal estate taxes as well over whatever limit the federal limit is. And then separately, the estate will have to distribute for state level estate taxes over this limit right here of 1 million.
Yep.
Correct?
That's
Okay.
correct. So it's the potential ultimate like tax rate between the federal estate tax and the estate tax can definitely have a huge impact if you live in one of these states,
Right.
to the amount that would be left to their heirs, or
Hmm.
distributed to their heirs after they pass. So
Okay.
again, if you live in one of these states, just pay close attention and watch. The good thing is that we've seen a trend within recent years of some states either reducing their state tax or even eliminating it. Iowa
Hmm.
is one of those states that got rid of theirs. So it is potentially something that will happen in the future, but you can assume that if you live in one of these states that you do need to be concerned about it and talk to your estate planning attorney if you do live in one of these places.
Okay.
So
All
let's
right.
take
So
a
are we going
look.
to talk about inheritance tax now?
Yeah.
Yes. Okay.
Yep. So these are the 5 states that have an inheritance tax, and you can see that there are much lower exemption amounts for this. And if you live in Maryland or Pennsylvania, almost every asset that passes to a non-spouse will be subject to the state's inheritance tax. And since many of the folks that are viewing this webinar live in Pennsylvania, we're going to take a closer look on the next slide at how the inheritance tax works in Pennsylvania.
Okay. Can you actually go back to the map
Yeah,
for
sure.
just a minute? I just want to tie everything together for those watching and listening. So the blue state, Maryland, just to reiterate again what you said, with
Hmm.
Maryland, the lucky residents of Maryland have to potentially uh, plan for federal estate tax, state estate tax. So those are on one side of the proverbial aisle in terms of
Hmm.
having to pay taxes before the estate is even distributed. And then
Correct.
in addition, Maryland residents would need to consider as beneficiaries of any inheritance paying the state inheritance tax. So there's 3 different components that as a Maryland resident you may need to consider. Now, of course, that does depend how many of those 3 components depends on the value of the estate when it passes to the beneficiaries, because there are exemptions. Whereas Pennsylvania, let's actually look at a gray state. So if you're in a gray state, you may have to worry about federal estate taxes
Hmm.
if the value of your estate is high enough or large enough, but you wouldn't need to worry about or plan for state estate taxes or inheritance tax. Is that correct?
That is correct.
Okay. All right. Thanks, Scott.
Yeah. So let's hop back to the Pennsylvania example. One moment. Okay. So again, the inheritance tax in Pennsylvania is not applied to a surviving spouse. So surviving spouses, and this goes for the federal estate tax as well, or even the state estate tax. When passing between spouses, there's essentially an unlimited marital amount that can go. So even if you had $100 million, that would go estate tax free to your spouse. But when that spouse passes away, that's when it would be subject to any of the other taxes that would be potentially due, whether it be federal, state, or state estate tax or an inheritance tax. If you plan on leaving your assets in Pennsylvania to your children or grandchildren, they will owe 4.5% of the amount they receive. And for siblings, that amount increases to 12%. And for any other individual, such as, like, say, a niece, a nephew, an aunt, uncle, or even a friend, they'll be assessed a 15% inheritance tax on what they receive.
Mm-hmm.
And with limited exceptions, you can expect to pay inheritance tax on cash, securities, IRAs, 401ks, real estate, revocable trusts, annuities, business interests, and other assets. The way the Pennsylvania estate tax or inheritance tax works is that it's due at the date of death, and becomes delinquent if not paid within 9 months. If the tax is paid within 3 months of the date of death, the person paying will receive a 5% discount on the inheritance tax due. So again, since there is no exemption amount in Pennsylvania, every asset that is part of a part of your estate will end up being subject to those inheritance taxes. So it is something
Mm-hmm.
that all folks in Pennsylvania should be aware of. Um, and we'll talk about a little bit later just some of the ways that potentially you can try to avoid some of these or offset some of these inheritance taxes. But it is important to remember, again, if you're a Pennsylvania resident, you will end up seeing inheritance taxes on the majority of the assets that you have when you leave those
Mm-hmm.
onto your family. So,
Yeah, absolutely, Scott. Some wording that you and I have used a couple times is, part of your estate.
mhm.
And that's important to point out specifically is that these tax rates, the inheritance tax, even the estate tax at both the federal and state level, it is applied to the value of your estate. And when we say that, we are talking about your estate in terms of an estate planning perspective. So
Yep.
how can we potentially minimize our estate? And that's part of what we're going to talk about in the next slide. But that's just something I wanted to clarify is depending on how your estate planning has been set up, has been done with your attorney, not necessarily all of your assets would be applied this tax rate. Specifically, Scott, that's why you said revocable trusts rather than irrevocable trusts, for example. And I know you're going to get into that a little more, but just wanted to clarify that. So
yeah, that's a great point. And again, there are ways to help minimize those, and that's one of the ways that we can do that. So let's take a look at the things that you can do. So these are some of the ways that you can minimize these taxes. And when it comes to minimizing possible estate or inheritance taxes, gifting actually is one of the best ways to help reduce the taxable estate. For 2025, you can gift up to $19,000 per year to as many people as you like. If you're married, each spouse can gift $19,000 each to any individual for a total gift to each individual of $38,000 per year. The one thing I want to point out, and this is a very common misperception around gifting, is that $19,000 a year or $38,000 a year for a couple is the maximum that can be gifted without incurring a gift tax. That's something that's not correct. As an example, let's say that a couple chooses to gift their children, and this is something that we often see with families, is that they might choose to gift their children $100,000 each to help purchase a home. There would be no gift tax due on those gifts. The gifts just need to be tracked via filing a gift tax return, which is a Form 709 with the IRS. And in this example, there would be a reportable gift of $62,000 for each child. So it would be the $100,000 that they gifted minus the $38,000 exemption or exclusion that they had, and that would be $62,000 per each individual for each child, for a total reportable gifts for the family of $124,000 that year. That amount goes against your lifetime exclusion amount. And in 2025, that amount is the same as the estate tax exemption, which is that $13.99 million for an individual or $27.98 million for a couple. So no gift tax is due until those lifetime limits are exceeded. So again, if you're giving that $100,000 or even $1 million, all you need to do is file a gift tax return, but no gift tax is due until you pass that $13.99 million as an individual or $27.98 million as a couple.
Which is a lot to gift over your lifetime.
Yes.
So
yes, it is.
Similarly to how we were saying a few slides ago, not too many people probably will need to plan for federal estate taxes. It may be the same in terms of taxes on gifting.
Correct.
Because that amount is just so high. That form, to your point, that form is for record keeping purposes, simply. And that's something that you would file with your CPA or accountant. Now, one thing I do want to point out is if you are thinking of gifting stock to your kids, you're still going to have to pay taxes on any income that the stock generates, right? So there's one little difference there. If you're trying to gift stock or any sort of equity or investment to children or anyone really, that's not a charitable institution, then you're still going to have to pay taxes on the income generated from that asset. I will also point out, gifting is, out of all these things that you list here, Scott, gifting is probably logistically the easiest thing to do to minimize your estate, right? Because you are simply giving money or assets away to loved ones or friends or whoever you would like. At the same time, it's such a personal decision, right? There's a lot that goes into it. It's not just about the dollars and cents. You and I had a meeting yesterday with one of our dear clients, and we discussed the idea of gifting just so that she was aware that that's an option to her. And if you recall, her response was, they have to earn it, and that's
Yeah.
okay. And so, many people choose not to take advantage of this strategy because, of that personal philosophy, and that's okay too.
Yeah.
529s, I would consider 529s as part of a gifting strategy.
Yeah.
And 529s or even UTMAs, although I would say anecdotally, we see 529s used more often in terms of
Mhm.
gifting to minors, but that could be, a happy medium if one of your concerns is, what are they going to do with this money, right? But
Yeah.
529s could provide those parameters or those guardrails to make sure that the legacy, the financial legacy you would like to leave, is being used in a way that would make you proud and is in line with your values. So,
Yeah.
just something for those listening to think about. It's a great strategy. It's relatively easy to do, but there is a lot of thought to go into it because of just the nature of giving wealth to someone. There's a lot to
Yeah.
think about. Absolutely.
Yeah, there definitely is. And one thing, I mean, anytime you're planning on gifting, I mean, talk to your accountant, CPA, or your financial advisor to discuss potentially what you want to give, whether that be, again, as you said, like maybe cash, or if it is
Mm-hmm.
stock. I mean, it may make sense to not gift the stock because your children would then lose the ability to get the step up of basis when you pass away. So
Absolutely.
stock might not be the most efficient thing to gift during their
Mm-hmm.
lifetime. It might be something that wait on that, but then give them something else during
Right.
their lifetime that potentially uh, they'll be able to get a benefit from. Or like you said, with the 529 plan, like grandparents, we see this quite frequently. I mean, they'll gift to their grandkids 529 plans, and they can even do what they call like a super funding of their 529, where they can give at one time. I believe it's up to $75,000 at one time.
Mm-hmm.
It's basically 5 years worth of contributions at once.
Yes.
They can do that, and that's a huge benefit for a kid. I mean, someone that's maybe 2, 3, 4, 5 years old, and the amount of
Mm-hmm.
time that 75,000 would have to grow for the grandchildren to help pay for their education. I mean, it's very
Mm.
very effective for being able to gift those to the grandkids that way. So
Absolutely. And 529s, they're easy to set up. They're
yeah,
relatively low cost, different options available depending on what state you live in or what college or type of education your grandchild or child may be wanting to pursue. So
yeah.
um, all right.
Yeah, and you mentioned before we on the previous page about trust,
Mm-hmm.
and trust, and I mean, really, one of the things that trust can do is they can help minimize inheritance taxes or estate taxes. There are generally two types of trust, and you mentioned this before: revocable and irrevocable. Revocable trusts are very useful for estate planning, as assets named by the trust will avoid probate. However, the assets held by a revocable trust are included in the taxable estate and thus subject to estate and inheritance taxes. In contrast, assets held by an irrevocable trust are not included in the taxable estate, so they're not subject to estate or inheritance taxes. So even if you're not likely to have a federal estate tax problem, and an irrevocable trust may be appropriate, especially if you live in one of those states that do have their own estate or inheritance tax.
Mm-hmm.
Discussions on the best type and use of trust is best had with your trusted estate planning attorney. And if you don't have one, we're more than happy to provide a referral to many that we work with.
Yes, absolutely. And um, we like to encourage our clients, and for those of you listening who don't work with the Hapanowicz, we would really encourage you to think about having your advisor on those calls or
Mhm.
even listening in on those meetings, whether you're doing a review of your estate plan or drafting documents for the first time. And the reason why is there are so many terms that are thrown around, and especially when it comes to trusts and deciding whether or not you want to fund a trust and what type of trust. There's, again, a lot of questions, a lot of terms thrown around. Your advisor most likely is intimately familiar with all of those terms and that language. And I mean, just from our perspective, Scott, we're in that space almost daily on behalf of
Yeah,
our clients or in conjunction with our clients. And so your advisor can almost act as an advocate on your behalf to make sure that your questions are getting answered and that you have full understanding and confidence in the estate plan that you are setting up with your attorney. And if you don't have an advisor with you when you are making these decisions, what I would encourage or say is, if you're going to set up a trust, or if you're thinking about it, just ask one question. What am I giving up by putting assets into this trust, and what am I getting? That
Yeah,
should
that's a
give
great
you
question.
that really good understanding of the give and take for the trust that you're potentially funding. So,
Yeah,
all
that's
right.
a great point.
Yeah.
So
Yeah, it's important, right? Because
it is.
especially for an irrevocable trust, I don't know if you can take money out of that, or if you can reverse that
Yeah.
decision, right? Of course, there are circumstances where you can take money out of an irrevocable trust, but
Yep.
there are parameters that are put into place that are considered permanent. So you just want to make sure that you have that full understanding before funding the trust.
Yep. Yeah. Great point. So let's move on from trust and take a look at charitable giving. And
Mhm.
we see this a lot as well. It is a very useful way to help minimize estate and inheritance taxes as you're removing those assets from your taxable estate. So whether you're gifting during your lifetime or leaving a bequest, there are many ways that charitable giving can help. So if you're charitably inclined and would like to support, say, your church, your school, university, or other charitable cause, charitable giving can be very fulfilling and effective. What we always like to point out to clients is that if you're not charitably inclined, which is perfectly fine, um, this doesn't mean that you need to start becoming charitably inclined in order to help reduce your estate or anything else. It just
Right.
means that if you are someone that does have an active history of giving to, again, one of those types of things like a church or a school, charitable giving can be a very, very effective way to help fund the things that you like or are passionate about or love, but also help reduce your estate taxes or inheritance taxes in the end.
Yeah, absolutely. And I would also say charitable giving, even gifting, but charitable giving especially, that's really a good example of where estate planning and tax planning really go hand in hand.
Yeah.
And also financial planning as well, because your advisor tends to have that intimate knowledge of all the assets, that you own. And if you're going to maybe be more intentional about charitable contributions, there's more than likely a more tax efficient way to go about it, or a way to, just maximize your tax planning. And so we would encourage you to, if you're already gifting to your church or a particular charity, review that with your advisor and see
Mhm.
if they have any ideas or thoughts of how to, again, maximize that strategy. It's something that, especially with, our high net worth clients who maybe have taxable investments and embedded gains in in those investments, that could be a really great way to address that. So you just never know. It may not seem like something very straightforward that you should bring up to your advisor, but we always say, when in doubt, mention it to your advisor, because more likely than not, there's probably something that they can help you with, or at least be a sounding board,
Yeah.
for that and really anything else. So.
Yeah, no, that's a great point. With charitable giving, I mean, there's a lot of different ways. And going back to that first example with the gifting, like
Mhm.
gifting stock, that might be what you do with the charity, because they're not
Yes,
going to end up paying on any gains that have been made within the individual stock that you might own, um,
exactly.
or or to help, as you mentioned, like with tax planning. Qualified charitable distributions. If you're over the age of 70 and a half, you can make
Hmm.
those from your IRA, and they will actually help offset required minimum distributions in the future. So
Hmm.
that's another thing that can be very helpful, and that's, again, another great way to do it. Again, there's lots of other different ways to deal with charitable gifting, but those are all things that if you have that conversation with your advisor, they can sort of help you walk through the different types of options available and what may be the best solution given your particular circumstance.
Absolutely.
So.
Absolutely. All right, what's next?
All right, life insurance.
Okay.
This is probably the classic use case for life insurance. The
Mhm.
biggest caveat to using life insurance is that it can be included in the taxable estate for federal estate tax purposes if it is personally owned. And the vast majority of policies, when you are buying an insurance policy, most likely you are the owner of that policy. And that means that it's personally owned and could potentially be included in the taxable estate. Um, so what happens is that generally we use something called an irrevocable life insurance trust to own a policy because that's a best practice to avoid those life insurance death benefits being included as part of the taxable estate. Um, Again, life insurance owned by an irrevocable life insurance trust is one of the most effective ways to help us pay the estate tax or offset any estate or inheritance taxes due. Um, from a state inheritance or estate tax perspective, it can vary. So it is best to check with your estate planning attorney or advisor. As an example of this, in Pennsylvania, a life insurance policy does not need to be owned by that irrevocable life insurance trust to avoid that death benefit being subject to the inheritance tax.
Mhm.
And again, as with any other technique, life insurance, its death benefit and its ownership is something that we should review on a fairly regular basis, every 2 to 5 years, somewhat similar to how we encourage you to review your estate planning documents on a every 3 to 5 years, just to make sure everything is up to date.
Absolutely.
And finally, here, we're going to talk about what they call a family limited partnership. So, if you own a business or income producing real estate, the use of a family limited partnership can be an effective way to help minimize or the estate or inheritance taxes. Typically, what the way this works is a parent will set up a FLP and transfer their business or income producing real estate into that FLP. They are considered what they call the general partners and have full control of the FLP and all of its assets. They then gift limited partnership interests to their children or grandchildren or whoever it might be, often by using that annual exclusion amount. So again, 19,000 per individual or 38,000 per couple. If they choose to gift more, they certainly can do that as well, as long as they file that IRS Form 709 as a gift tax return, just to track the amount that they're giving over those annual exclusion amounts. The children themselves are considered limited partners, so they don't have any rights or to participate in the management of the family limited partnership. They may have some voting rights or limited matters, but control of the family limited partnership is held by the parents. So again, as long as they're alive, if they could have gifted away 99% of the business to their children or their income producing real estate to their children, they have just 1% of the assets left, and they still have full control over it. The kids can't do anything like try to sell the property or sell the business or anything like that until the parents are gone. So the parents still have full control, even if they don't own the full amount anymore. So,
Mhm.
and
Okay,
again, it.
so
Sorry, go ahead.
go ahead. Go ahead, Scott.
Yeah, no, a great thing about it is it really helps to efficiently transfer to the children during the parent's lifetime, and that's the big thing
Mhm.
is that you're trying to get those properties or you're trying to get that business out of their taxable estate while they're
Right.
alive, but it still gives the parents the control that they want.
Right. So any portion of the business that's still under the parent's control or within the general partnership, that is still considered part of their estate and would
That's
be
correct.
subject to estate tax and inheritance tax. Okay.
That's
Okay.
correct. Yeah. So if they've given away 60% and they still own 40%, that 40% would be included in their taxable estate
Okay.
or be subject to inheritance taxes. Correct.
Okay. Great. All right.
All
So we talked about things we can do. Now, what are some things we should not be doing?
Yeah. Probably I'll be honest with you, the most common thing that we see is not having a plan
Yes.
or having a plan that's outdated.
Yeah, that's right.
Yeah, the majority of the people that, I mean, again, we've said this multiple times throughout the presentation. The majority of people will not have an estate tax problem, or at least a federal estate tax problem. But you should still have a plan in place to make sure your estate passes as efficiently as possible to your intended heirs. And we know life and circumstances often change, so make sure to periodically review your previous decisions to make sure that they're still appropriate. And it really is something that we see far too often. I mean, I was helping a client the other day. I mean, actually, it was the same client we were talking about that we were talking about from
Yes.
yesterday about
Hmm.
gifting. She still does not have all of her estate planning documents up to date. And
Hmm.
that's something where we will continue to provide a friendly reminder that she needs to get that done, because if something were to happen to her, it things might not go the way she wants to as far as how those assets are passed on. So
Hmm.
it's very important to have those documents in place. And again, people that have that could potentially have millions of dollars, they might not have all of their documents up to date. And if they don't, that can have a really big impact on potentially how those assets are handled when they do pass away.
Yeah. And even beyond the handling of assets, your financial and healthcare powers of attorney are part of your estate plan. And
Yep.
because of that, every single person needs an estate plan. Even if you don't have any money to your name, you need one.
Yep.
Um,
Yeah,
a
that goes to
lot
the
of,
next point perfectly. So yeah.
yes, yeah. Well, then go ahead. I did that on purpose, Scott. Go ahead.
Yeah, no, I mean, and it is. I mean, making sure that you're choosing the right executor, you have your POA, your powers of attorneys, your medical and financial powers of attorneys updated is super important. And especially if you have a young family, or if you're like, say, your own children have and they have children, so it's your grandkids, they need to make sure they have updated guardians. And if you have a trust, having a trustees updated is very important. Make sure you communicate those decisions to name someone, especially as an executor, because they need to understand the responsibility if something does happen to you in the future. And the same thing for those powers of attorney. They need to be willing to carry out the duties that are listed in your power of attorney to say, okay, I've decided I want to have you pull the plug if it's this, this, and this, and I'm in the
Hmm.
hospital. They need to be willing and capable of doing that, because you might have somebody that's a family member, and that's perfectly reasonable to have a family member as one of those people, but they need to be willing to make that hard decision for themselves to say, okay, this is what she wanted, or this is what he wanted. We need
Hmm.
to do this. So making
Right.
sure you've clearly communicated what you need to do to have those in place. It's really important to have those conversations. I know it's not a fun conversation, but it is super, super important to do that.
Yeah. You mentioned young families.
Yeah.
I have a 2.5-year-old. My husband and I did our estate planning documents, drafted our documents with our attorney shortly after he was born. And look, it is a process, right? And it's an investment, but I mean, well worth an investment. And um, I think we like to touch upon this so much because many of our clients that work with us, they have children or grandchildren who may need to hear that from them, from their own
Mhm.
parents or grandparents of, hey, have you gotten your estate planning done? Again, it's not necessarily just about the assets or the money. If you don't have a lot of money to your name, that's okay. You still need an estate plan. So
Yeah. Yeah, perfect point. I mean, and that really does, it is one of those things. And that's one of the reasons we also encourage to update your documents or review your documents every 3 to 5 years,
mhm.
primarily because you may have added, I mean, you may have added, say, like your medical power of attorney could be your mom or your
Mhm.
dad. And if something happens to them, or they pass away, who's the successor power of
Right.
attorney? And making sure you keep those items updated. And even actually, I was in a meeting with Bob of Hapanowicz Financial. So Bob, and he was pointing out that there's been some big changes into the way power of attorney documents are
Absolutely.
written in Pennsylvania.
Mhm.
And if you haven't had those documents updated within the past 5 to 10 years, there's a very good chance that they might not be effective if you did need to utilize
Yeah.
them in the future.
That's
So,
correct. The
yeah.
banks, even if the document is in good order, the attorneys have told us that the banks will not accept the POA
Hmm.
documents because the language is dated and they don't
Yeah.
want that liability. So it's so, so true. Even if you don't feel that you need to change any names, if
Yeah.
it's been 3 to 5 years, we say at minimum every 5 years, have a sit down meeting or phone call or Zoom meeting with your attorney because you never know. You don't know, and that's your attorney's job, is to be aware of all of those things. So
Yeah. Yep. One of the other things I'd like to point out is many people don't realize that certain assets that you own can avoid probate.
Mhm.
Most banks or credit unions will allow you to add what they call a transfer on death or a payable on death provision to the account. So oftentimes it's just put down to the acronym TOD or POD. It also applies to taxable investment accounts as well. So make sure that you have current and appropriate beneficiary designations on your bank accounts as well. So those TODs or PODs essentially become that beneficiary designation. And if it is on the accounts, that will mean that it will avoid probate. And you want to do whatever you can, if at all possible, to avoid assets going into probate. Sometimes it can't be avoided. But again, bank accounts and investment accounts, if they don't have a beneficiary designation, like say an IRA, 401k, some other employer sponsor plan, life insurance, and annuity, um, then you can still add those TOD or POD provisions to the account to
Mhm.
make sure that you're doing everything you can to make things as efficient as possible when you do pass away.
Right. And we'll be going into April soon and going into what we here at Hapanowicz call our second season of wealth management, which is when we like to intentionally review things with our clients through
Yeah.
the lens of estate planning and legacy planning, including insurance coverage as well. But I say that because that is one thing that we do review. We review all beneficiary listings or lack thereof. So even
Yep.
on, to your point, bank accounts, individual accounts, even joint accounts, you can add a TOD designation, and that's actually
Hmm.
considered best practice. So your advisor at Hapanowicz will be reviewing this with you on an annual basis, not just your IRA beneficiaries. Now, Scott, if someone were to add uh, a, a if someone were to add, let's say, their son to their bank account so that it's joint ownership,
Hmm.
would the assets, that bank account would avoid probate, even if there was no TOD designation, correct? Because there's a joint account
That's
on there.
correct.
Okay,
Yeah,
so
and that's
mhm.
that's actually one of the couple points down. That's one of the things we'll.
Oh, you know what?
No, yeah, and
Then
yeah,
yeah, yeah. If you want to skip to that, it's fine. Or
yeah,
if you want to,
yeah.
I
No,
see.
I
I
mean
did it on purpose again, Scott.
yes,
I've
you
been
did. Yes,
practicing
and I
extensively.
appreciate that. You're getting ahead of me every time.
Yeah.
I love it. um, well, and adding your child or, I mean, somebody else, a family member to your account, like a bank account as a joint owner, that certainly can make sense. The one thing we would want to point out, though, is that if you added on certain types of accounts, though, like say a joint owner on like an investment account or something else like or your home, that could be something that sort of creates a problem. Again, on
Hmm.
a bank account it's not a big deal, but if you add it to say an investment account or to your home, adding them to like the deed, that could end up being a problem because then you have a problem with potential taxes when they do pass away.
Hmm.
The joint, I mean, on a bank account, not a big deal because there's not going to be much growth that's going to occur within a bank account. So any taxes are not going to be an issue. But for investments like stocks, bonds, that type of thing that are in a taxable investment account, because that's where it creates a problem. To give you sort
Hmm.
of an example of how that works, let's say that you have an investment account that's valued at $300,000. The cost basis in that account is $100,000. So to remind folks what cost basis is, that's how much money was originally invested, was that $100,000. So that means that if it's now valued at $300,000, you have a $200,000 gain in that account. If you pass away and your child, if you pass away and it's just owned by you individually, your child would receive the full step up of that $200,000. So now their new basis would end up being $300,000. However, if you ended up having them listed as a joint owner, they would only receive a step up of half of the gain amount. So they would end up having a step up to $200,000, and they would still owe taxes on $100,000 of gain. So you lose that step up when you add a joint owner to that account, and that's when it doesn't necessarily make a lot of sense. And the same thing would go with a home as well. So just be careful if you're thinking about adding children to a joint as a joint owner on an account. That's perfectly fine. Again, if it's say a bank account or something like that, but on any other asset, have a conversation with your CPAs, have a conversation with your financial advisor, because we really want to make sure that you're doing things as smartly as possible in order to
Right.
make sure that you're maximizing things when they do go to the next generation.
Absolutely. And that's why I asked that question, is because if you're trying to add a joint owner onto a larger account, an investment account, just
Mm-hmm.
to avoid probate, there's going to be a cost benefit analysis there. And a lot of the
Yeah.
time, losing the tax benefit for your beneficiary would outweigh the benefit of avoiding probate. So,
Correct.
all right, we skipped one because I was
Yes.
moving too far ahead of you. So why don't we talk about mismanagement of trusts?
Yeah, and that's we'll just quickly touch on that. I mean, if you do set up a trust, there oftentimes are specific duties, responsibilities, and processes that must be followed. So make sure that you speak with your attorney to understand those requirements. And that goes back to when we were talking about using trust as a potential way to help avoid or eliminate estate or inheritance taxes, is that depending on the type of trust, especially if it's an irrevocable trust, there may be certain specific things that have to be done each year to make sure that those assets are not included in the taxable estate.
Right.
And even the revocable trust, there are certain duties that may occur. So
Mhm.
just be aware of how that works, and talk to your attorney to make sure that you're doing the right things. So
Absolutely. All right, last but not least.
yeah, so the one thing I'll say is, take a look at digital accounts, and assets that you have, or not assets, but accounts that you have that are like, say, Facebook, any other types of online accounts that you have. Nowadays, what happens is, I'm going to do one thing real quick. One thing that I'll say for the digital accounts is that often when we're doing estate planning documents now, that's often included. The attorneys that are doing the estate planning documents are often including specific things in regards to the digital accounts and making sure
Mhm.
that all of that information is documented so that the heirs do have a way to get into those accounts, shut them down if they need to, access other online accounts, financial accounts, or whatever it may be. And that is something that we definitely see many clients doing now. Make sure that you do have a lot of that stuff up to date. If it's not through your will where they add some of that information in, at least make sure you're documenting it and providing copies to your children so that they know how to get access to those things.
Yeah. Yet another reason why you should have your documents reviewed every so often, because if it's been 10 years, that wording that you mentioned, Scott, that
Yeah.
attorneys just automatically use now or include probably isn't in those 10-year-old documents. And
Yeah.
I mean, what a nightmare would it be to not be able to get into a Facebook or Instagram account and shut it down, right?
Yeah.
So much of our world is online now, that, it's a provision that attorneys, for the most part, are just automatically including, but it's something to ask your attorney about too next time you speak with them. So,
Yeah. Great point. All
all
right.
right. Thank you very much. There were a couple questions that were submitted. We had questions submitted ahead of time, and for purposes of time, we picked out 3 of those questions to answer today. So I'm just going to pull them up here. I'll ask them, and Scott, you can answer them. Okay.
Sure. Yeah.
All right. So first question here. We kind of already answered this, but if I don't have an estate
Yeah.
tax issue, do I still need to do estate planning?
Yeah, we did answer that. I think in one of the last things there is not having an estate plan or not having it updated.
Mhm.
It really is important to have a that will, the financial power of attorney, medical power of attorney, and living will in place, because those documents provide the instructions on how to handle your affairs should you become incapacitated or if you pass
Mhm.
away. So, in addition to those documents, you also want to make sure that your beneficiary designations are up to date and that you have titled certain financial accounts in a way to help avoid probate. So, um, if you do not have the items in place again, or they're not up to date, the estate may be subject to distribution by the state of your residence. So if
Mhm.
you don't have those documents in place, the state of Pennsylvania or the state of Maryland or the state of wherever you are could decide how those assets are distributed. So it makes a lot of
Right.
sense to make sure that you do have those documents in place and that they are up to date. Again, you might not have a federal estate tax problem. Again, most of you will not, but you certainly potentially could have a state estate tax problem or a state inheritance problem. So making
Mhm.
sure that all of everything is up to date really does make sense, to sit down with an attorney to make sure that you have everything up to date and ready to go.
Absolutely. Okay. All right. Next question. I am 56 and inherited a large IRA from my mother, I have to pay the inheritance tax and will have to take a distribution from the IRA to pay it. Will I owe an additional tax penalty on this distribution because of my age? Okay, so just to give folks tuning in some background as to why this person is asking this question. For retirement accounts such as an IRA or even a 401k, age 59 and a half and older is, if you take distributions from your retirement accounts, that's considered normal retirement distributions. And any distributions from retirement accounts, if you are younger than age 59 and a half, are considered early retirement distributions and could be subject to additional tax penalties on top of income taxes if you don't follow some rules, which are very specific. There are very specific rules to follow. So that's why this gentleman is asking this question, because he's 56, he's younger than 59 and a half. So Scott, when he takes out an IRA distribution to pay the taxes, he'll have to pay income taxes, but will he owe an additional penalty tax?
Yeah, the penalty tax would not end up applying in this situation. So the way inherited IRAs work in 2025 is that they must be liquidated by the end of the 10th year following the original owner's date of death. Since you're required to take those distributions or death distributions from the IRA, the normal 10% penalty for taking those distributions does not apply. So for this particular example, the 10% penalty would not be something that they would be subject to because the IRS requires them to take those distributions within a 10-year period of time. And it doesn't matter if they were 56 or if they were 20, they will not end up having to pay that 10% penalty.
Okay. All right. Thanks, Scott. All right. So last question here. My children know they will be receiving a sizable inheritance from my husband and me. We have our estate planning documents in order. Is there anything they can do, so their children can do on their end to minimize the inheritance tax they will have to pay?
Yeah, it's really tough to be able to plan for that specific thing, other than getting your parents to, or getting the parents to do certain things of their own, as far as planning is concerned. Like they could purchase life insurance to potentially help pay for those inheritance taxes. But it's honestly, I think probably the best thing you can do, especially if you're the parents in this situation, if you're comfortable with it, we usually say bring your children into the occasional meeting that you have with your estate planning attorney and financial advisor. I think that's something that's really important. Having the children build a relationship with the team before you pass will help essentially get them prepared to handle your affairs and come up with a game plan to help deal with the potential eventual inheritance taxes. And please keep in mind that you don't necessarily need to disclose the value of all the assets to the children. We understand there's a lot of privacy issues there, and you might not want to reveal to them potentially what they will get, but it does make sense for them to know what happens when an investment account or an IRA is left to them. And that's one of those conversations that we can help facilitate so they understand how those assets will be taxed and what will happen when they do inherit to those assets.
Yeah. There's unfortunately not a concrete thing that the children can do because it's not their estate to plan. They're going to inherit whatever they inherit, and it's up to the parents, which it sounds like they've already done this, but it's up to the parents to do the estate planning to try to minimize their estate in any way possible, if that's something that's important to them. Now, to reiterate the importance of that communication that Scott was talking about, if that's something the parent is comfortable with, another reason why that could be really beneficial to the child or to the children set to inherit these assets is because perhaps one or all of the children have, a type of income source that is somewhat flexible in terms of which calendar year they can recognize that income. And so if they have an idea of, a windfall of wealth that they will at some point expect, then they on their end might be able to maneuver other things in their own estate, maybe the timing of certain income sources, perhaps, to spread out those tax burdens of, inheritance and income. And so, that's not necessarily a concrete thing, but it's more so another reason for communication being beneficial, if that's something that, you are willing to or comfortable with doing. And again, to Scott's point, it doesn't mean that they have to know every dollar amount, but even just the
Yeah.
components of the inheritance that they could expect, that could be helpful.
Yeah, and it's a great point. Again, and it's whether it be IRAs that they might be getting, or a um, basically like they own individual stocks or whatever it might be. Knowing
Right.
how those things operate and how they'll end up, what the impacts of them tax wise will be, is something that any of those children would be happy to probably know if they don't know about it already. And again, we
Hmm.
don't have to name, you don't have to disclose dollar amounts or anything like that. Because again, we do have many clients that don't like to discuss the specifics, but
Hmm.
giving them a good overall feel for what the expectations are, how those things will end up being taxed, is something
Hmm.
that they all can benefit from.
Absolutely. It's so true. And we can round out with, for those who are tuning in, who are clients of Hapanowicz, you will be familiar with the term seasons of wealth management. It's something I mentioned a little bit ago as well. That's what we call our service model. So each
Mhm.
season throughout the calendar year is meant to intentionally review things through the lens of either comprehensive financial planning and investment strategy, estate planning and insurance planning and legacy planning, and then at the end of the year, tax planning. And so this is a timely webinar because we're going to be moving into our second season very soon here in a matter of a couple of weeks, where we will be reaching out to you to review things through the lens of estate planning. So hopefully this is some food for thought. Those of you tuning in live and listening to the recording or watching the recording afterwards, think about this between now and then. If you don't want to wait until your second season meeting, which for many clients, that second season meeting has already been scheduled. But if it hasn't been, your advisor will be reaching out to you to schedule it. And in between then, if you have a question, if you don't work with Hapanowicz, but you still have a question, please feel free to reach out to us. Our number is on the slide here, as well as our emails, Scott and my email. And make sure to keep an eye on emails and our YouTube channel for updated and new webinars. And Scott, thanks so much for being with me today.
Yeah, it's been great. Thank you again for everybody that joined us live. And if you do have any questions, again, just feel free to reach out to us, and we'll be more than happy to assist.
Perfect. All right. Thanks, everyone.
Have a great day.